Hello, Oracles. Just hopping on a little bit early, ready to go early. So give you guys some time to hop on here. Oh man, what a day today. Nice little red day in the market. Great buying opportunities out there. Pretty excited about this. I'll show you guys on the live stream tonight as well what I'm doing with my spreadsheet and how it worked out today. Just because you'll be able to see on there how my spreadsheet works, where it shows how much money I have to spend and what stocks to be able to spend money on. So I'll share that with you guys tonight as well. But man, what a day today. How do you guys feel about it? Now, this is something that I've worked with a lot of you in the past, especially when it came to Tesla stock on red days, especially if you're newer to the market and you're not used to these things, could be emotional. You kind of like uncertain as to like why is these things happening? Why is my stock portfolio coming down? And I try to let's help you guys understand that if you're a long-term investor, this is actually a good thing. Again, remember, buy low, sell high. The stock market is red. That's low. Those are the times you want to buy. You should be excited about times like this. Obviously, you want to know why it's going red. And that's typically why knowledge and what I try to share with you guys and explain reasons why. You think back, hundreds and thousands of years ago, people were scared for many reasons because they didn't know. They were scared of the unknown. Then science would prove certain things, and then people weren't scared of so many things anymore. Well, it's very similar to times like now. In the market, you look at things in the market, it's like, if you don't know, the market doesn't like the unknown. The market doesn't like uncertainty. So you get into times where you don't know, you get scared. The thing is the reason why funds and institutions do so much better than retail investors is because they know. They know why the market is moving in certain directions. They're not scared. They don't have that true uncertainty, despite the fact that that's what we call it. Retail investors, on the other hand, don't have that knowledge. So I try to help you guys and share that knowledge with you so you have an understanding as to why the market is moving the way it's moving, what's going on, and why it's an opportunity. Is it an opportunity? Do we wait longer? Things like that. But I just want to try to explain a lot of that to you guys today. And one of the big reasons today that we saw pulling back was the jobs report. So we'll go over that as well. So we'll give it a few more minutes for everybody to get on here. And again, if you guys have any questions, full live stream, I will answer every single question that pops up in the comments. We'll have full discussions on here. This is why I like to do the live streams, because doing the live stream allows me to have an actual interaction with you guys live versus trying to do through the comments section on my other videos. All right. I'm just going to get some of the stuff ready today for what we're going to look at. The first thing we'll do is we'll look at the jobs report so you guys can understand. So that came out at 8:30 a.m. this morning Eastern time, and that showed us signals. And I'm actually more scared of it. It was the unemployment number met expectations, but I kind of actually am afraid of that more than anything. And I'll explain why when I get into it in a minute. I'll give you guys a couple more minutes to get on here because I know I hopped on early. But let me just make sure I got the numbers ready here. Yep. All right, we're good to go. But let me know in the comments. Did you guys buy anything today? Were you guys buyers today? One of the things I like about my spreadsheet is, because of the way it runs by percentages, is if the market pulls down, it keeps the percentage of cash that I have of portfolio going up. So it's like, oh, well, the market's coming down. It frees up cash for me to buy. So if the market's going back up, it shrinks that percentage and it tells me, all right, market's going higher. Let me, add some cash to it. It's not a perfect science. Obviously, there's a lot better ways of doing it, but this to me is very mindless, and it's simple for me to be able to follow the market and just add to my portfolio in the areas that it needs to be added to, or keep stockpiling more cash. All right, let me hop on here. I'll show you guys what I've got going on. Let's see, share. All right. So here's the unemployment report today. Total non-farm payroll employment increased by 142,000 in August, and the unemployment rate changed little at 4.2%. So the expectations were 166,000, I believe. Let me just double check that number. It was supposed to be, 165,000 was expected. So we came in lower than expected for the payrolls. Now the unemployment percent, 4.2%, did come in at expected. So I'll get into in a minute why I'm afraid of that. The July report was also revised down from 114,000 non-farm payrolls to 89,000. So again, that's lowering the July number to be even worse. So this goes into more details. I won't get into all the full details on this as the full breakdown. I just look at the main number is really the more important one to go by. Sometimes you like to dive in there and be like, well, where are the jobs coming from? Like over the last year, a lot of the jobs that we saw were coming from the government. Well, if the government's creating jobs out there and they're making it, that's great because people have jobs, but government creating jobs isn't like innovation growing out there and growing those jobs. When it comes to other corporations and other businesses, that's actually shrinking. So it's almost, I don't want to say it's like cheating the numbers because it's not, but you're kind of like inflating the numbers in areas that really aren't helping the economy grow. You're not creating any revenue coming in through government jobs. Think about a regular business. For instance, I work in retail, been a retail manager for 2 decades, and I've run P&Ls. And when you're looking at your P&L out there, you have your operational costs. That's all cost. The people who work in operations are necessary, but they are a cost to the business. Then you've got the revenue drivers, it could be sales and other things like that are actually driving the business forward and bringing revenue in. Both are necessary, but typically when you want to cut costs, you cut operational things and try to become more operationally efficient. When it comes to the government, typically, for the most part, people working in the government are costs. Everything is going to be a cost. So if you're trying to cut operational costs, adding jobs to the government is actually increasing the need for revenue. So it's actually counterproductive when you're trying to grow the economy by growing the government. It's just naturally how things work. So that could be a little more challenging there. Now, my big concern about the jobs report being at 4.2% when it comes to unemployment was last month we expected 4.1, came in at 4.3. That's why in early August we saw a massive scare in the market was, hey, we're seeing the jobs, the unemployment accelerating faster than expected, ended up triggering the SOM rule of over 0.5%, which historically has been a 100% accurate indicator of an oncoming recession. So us now coming from a 4.3 to 4.2, you're like, oh, great, the number came down. However, when you're looking at what the Fed's going to be doing when it comes to the rate cuts in the middle of September on the 18th, if we ended up getting a 4.3 or higher, the Fed would have absolutely gone with a 50 basis point cut. Most people out there are thinking we should be getting a 50 basis point cut regardless, because all these numbers that the Fed uses are such lagging indicators that by the time these cuts actually take effect, it's going to be too late. So now with a 4.2%, the Fed isn't going to be like, oh, we don't need to go 50 basis point. They're probably going to do a 25 basis point cut. To me, that is extremely dangerous. I think by doing a 25 basis point cut, it's really doing no good whatsoever to the economy and to the entire overall market. And I think what's going to end up happening is it's just kind of leading us even closer to that edge of recession by them only going to a 25 basis point cut. Now, I could be wrong. Maybe the Fed does end up going with a 50 basis point and, we get 50 basis point cut and the market's happy. But it kind of seems like the Fed's going to be slow in dragging their feet on this and stick with a 25 basis point cut. So we'll see what happens, because then after this, the next FOMC meeting, I think, is right after the election. I'd have to double check if you guys know, you could go ahead and check, but I think it's right after the election. So I think it was supposed to be on election day and they moved it to the day after because they didn't want it to conflict for whatever reason. So I think it's going to come the day after. So if they don't do a 50 basis point cut now in September, we have basically a month and a half before the next FOMC meeting. So we're going to get 2 more jobs reports. We'll get the jobs report in October for September, and we'll get the jobs report in November for October prior to that. If we end up getting 2 more jobs reports that are showing, scarier unemployment numbers, we may end up getting a 50 or 75 basis point cut. 75 basis point cuts, typically anything more than that is like, the Fed is panicking and they're trying to kind of get ahead of this. So we'll see how that all plays out over the next couple of months, and obviously the next couple of weeks. We'll see. And Hanif, thank you. Yes. Canada just cut their rate by 25 basis points. And historically, when we saw the hikes coming, there was a couple of times where the US Fed didn't mimic Canada, but for the most part, they did mimic Canada. So if there's a 25 basis point cut in Canada, we'll probably get the 25 basis point cut here in the US also. Again, I'm not happy about that, but as far as I'm concerned, this is what I'm preparing for. And I'll show you guys my spreadsheet now as well, because when I'm looking at all of this, this is why I have literally prepared myself for this. So here's my spreadsheet. And on here, down below, again, this is my cash, my investable cash position at $4,765. That right now, based on my goals, is just over 9%. And I've been sharing with you guys that I'm on phase 9. And my phases go by this. Each one of these colored sections has a set amount that I want to have these stocks equally weighted balanced to. So stocks and ETFs. And for instance, right here, you look at the formula, and this whole section in green, I want to get them all to $1,250. So anything that's under $1,250, as for instance, Devo right here, shows that I have to add $5 to it to get up to that level of $1,250. So now when it comes to these are my longer term play ETFs that I want to just keep on holding long term. These here, I'm looking at getting them to 1150. And then my individual growth, dividend growth stocks, I'm looking to get those to 450. So again, this is how the whole formula works. So when I'm looking at this, it says to me that based upon the 9% I want of cash, I have more than 9%. So I have $13 to spend. And I just go top to bottom. And so next I will be adding $5 to Devo, and then I'll be adding $10 to CGDV. And I just keep on moving my way down the list. And like today, I would add some things to the top. Then the market kept on falling. I showed more cash freed up, and I would add more to the top. And that's all I kept on doing all day long. And this in turn is buying me income. Now, here's the great thing about this too, is right here it's showing me that I'm pulling in $380.54 per month based upon this. Now, some pay out quarterly, but I broke it down by month just to make it easier. But this is my payment per month, and then this is interest of about $31 per month in interest based upon all the cash I have in my high yield savings account. Now, what's going to be happening over time, as I've already seen through SoFi, is my high yield interest came down from 4.6% to 4.5%. So when the Fed ends up cutting rates, this will come down even further. So the yield on my cash will be going down. So as the yield on my cash goes down, I'm going to be deploying more and more cash of this into my stocks. So that means that, yes, maybe some of these aren't yielding as much as my savings yet, but as the rates come down, my savings will come down in yield, and these in turn will be higher yield than my savings. So it's just that slow trickle from one to the other, keeping it balanced. Because as I've been adding over the last couple of days, my overall pay has stayed the same. That income coming in on a monthly basis is $411. That is, fluctuated slightly by pennies, and that's really it. However, when we start to see this coming down, because I will have less cash available, that means that my interest will also, when the interest gets cut, that means that that's going to come down, but I'll have more money in other areas to bring in that yield. So to me, that's how it's going. So I'm literally buying income at a discount, and this entire spreadsheet is telling me where I can add and make the most value from it because, hey, these are on sale. Devo is on sale. All of these are on sale. I've got Cat on sale. Occidental is on sale. Google on sale. AVGO on sale. Microsoft on sale. Now, sure, some of them may still be a little bit inflated because of the AI push that we've had over the last year. But based upon my equal weighted numbers here, these have been coming down and they're at a point where, hey, now it's time to add some and I can get more. I'm not dumping a ton of cash into these. I'm just kind of trickling and dripping some cash in over time. And so that's been how I've been breaking this down. And I'll show you guys, again, this is something that I will end up finalizing. I want to share it with you guys to be able to use on your own because it's my entire full P&L here. So, and when I say P&L, so if you guys don't know, that is a profit and loss statement that is basically like your own earnings statement. So for you guys, hopefully you do know how to read an earnings statement when it comes to any of the companies that you are invested in. And reading your own investment, your own financial, or your own earnings report is great. So scanning through here, I've got different charts and stuff, but here's my entire P&L. So I break it down by, all of the different income sources that I have. So this is going to show me my full breakdown. So this is my budget that I've made for myself. This is what I've actually brought in. And then this is my actual versus budget and where I'm at. And I usually update this on a weekly basis. So this hasn't been updated this week yet. Then I have where all of my investments are going. So all of the money that I have coming in, where is it going to? Now I do have SoFi, and I absolutely love SoFi because it's got the vaults in SoFi. And I'm going to do it for 2025. If I have time, I'll finish off this year with it. But my money that comes in automatically goes into vaults. Some of those vaults are for current bills, like my mortgage. And again, that vault, that's $2,000 a month that's going to be in the mortgage. At the end of the month, I'm getting 4.5% interest on that money that is paying off my mortgage. So I'm getting about $5 to $6 every single month based upon the money I have put aside to pay my mortgage. It's pretty awesome. I know that's not going to last forever, especially as interest rates come down. But to me, I'm just making a little bit of extra money on the money I plan on spending. So it's the opposite of how we can't stand taxes, how we're taxed on the money we make, we're taxed on the money we spend, we're taxed on the stuff that we own that we've already paid taxes on that we've spent on, like a house and a car. This is kind of reversing that. Now, the money that I'm paying out to this, and it's never ever going to work in my favor entirely because it's just how the financial system works. But if I can recoup some of that more in my favor than just paying it all out, I'm going to take it. $5 is $5. So I'm just taking that, and it's working out for me. So that's why I have that money in there. But that's where all the vaults come from. So all those vaults I will put in here because the money that's coming in goes into vaults. And some of the vaults are for stuff that I'm going to pay for in the future. For instance, my son's college or any travel expenses that I want to go on. So like I've got my vaults down here right now. I haven't finished it out yet, but travel, college, my emergency fund, which I always recommend you guys have an emergency fund, minimum start with $1,000. And then from there, you want to try to build it up to 3 to 6 months, if not 12 months of all of your expenses in an emergency fund, because you never know what's going to happen. If we do get into a deep recession, maybe people start losing their jobs. If you lose your job, do you have money that can cover your expenses for 3, 6, or 12 months? Because if you lose your job and everybody's losing their job, that means there ain't many jobs out there. You're going to want some sort of, income source coming in, which is why I have so many income sources. Not all of them pay a lot for me right now, but they're options. And if I ever did lose my job, I know I can fall back on many of these and focus my time that I now have freed up on these areas to be able to build them up to generate more income. And then down here, I've got my 401k and HSA because those are important as well. And those just come out pre-tax. And then I've got all of my expenses that I go through. And again, all of this goes by budget. And then at the end of the day, I come down to where am I over and under? Where's my total expenses? What's my free cash flow? And I break out my free cash flow. And I'm going to do a better job next month or next year with my P&L, just because I like to have the visuals so I know exactly where every single penny is going. And then, of course, I've just got my detailed spreadsheet here of everything. So my detailed spreadsheet, shows all of my expenses. It's a very simple breakdown. I created this all myself. Just here's the date, here's what the source, this is the category it's going into, just totals up at the very bottom here, and all these get transferred immediately right over. So as soon as I add something to a column here, it automatically goes over to my P&L and gets totaled up in the appropriate column here. And so that to me is, just a way of doing it. And again, like for instance, my mortgage, like $2,000 a month, I don't have any checks coming in that are giving me $2,000 a month. I don't want to wait till the end of the month. So every single paycheck, I have $500 taken out, goes right into that vault, out of sight, out of mind. It's one of the things I did with my child support in paying that as well is it gets direct deposited right into my ex-wife's account. I don't have to see it. I'm never going to be late on child support payments. It's money that is not mine. I'm never going to see it. I'm never going to be tempted to spend it or anything. It's gone. So I do that with all of my vaults as well. That money immediately goes out into those vaults. I can't spend it on anything. I am never going to be late on my mortgage because through SoFi, that money in the vault goes right into the savings. And then right from there, it's paid directly. I don't touch any of it. I don't have to go on there and remember to pay my mortgage or anything like that. Everything is done automatically right through there. No questions asked. So every direct deposit that comes in, it immediately gets broken down into those vaults. I absolutely love SoFi. And, as you guys can see on here, that's one of the, let me get to it for you. That is one of the stocks that I own. I absolutely, so there's this dark green here. These are the high growth plays that I have that do not pay dividends. These are the only ones I have that don't pay dividends. Tesla I have in here, which I love Tesla long term, but right now I think we got some great buying opportunities ahead of us. So I'm going to just kind of, trickle into this a little bit over time. Amazon, I think, is going to pay, I think both of these, Tesla and Amazon, are going to pay dividends eventually. Amazon probably well before Tesla, but I think it's coming. So I'm just adding a little bit into Amazon and SoFi. I got 50 shares of SoFi. Love, love, love the company. I think as long as they get through, if we get into a deep recession, as long as they get through that, which I'm confident that they will, I think they are going to be a very strong player on the other side. They are catering to millennials and younger generations who maybe don't have giant net worths right now, but they are growing those net worths and they're going to be with SoFi for the long term, and SoFi will continue to help them grow their net worth. SoFi has been doing that for me for a lot of different reasons, both through investing, through the high yield savings account, through the vaults. They have been helping me out significantly. I am grateful to them for this. If they continue doing that for me in the future, I'm going to stay with them. They have made my financial life significantly easier. So I love them. So I highly recommend them. In the comments below, there is a link if you guys are interested and want to try it out. There's a link to my, I'm not an affiliate, but my link is down in there. I think I get $75 and you guys get $25 for maybe hooking up a savings account or down direct deposit, whatever it is. I'm not in this for the extras. The extras are nice bonus, but if you guys are interested and you want to try this, I highly, highly recommend it. It's awesome. And then Palantir. I love Palantir. And then a couple of cryptocurrencies, which I have been trimming this. So I trimmed a little bit of my Bitcoin, and sure, I think it might be going up higher after this, but I trimmed a little bit around the 60,000 mark just to free up some cash to put up here. And that's it. So those are my plays. But yeah, love SoFi. Amazing, amazing company. Let's see. Yes, honey. Let me see. Great financial advice that we don't get in college or university. Yes. And that's one of the big things too and I remember vaguely, I don't know if it was fourth grade, whatever. They talked about compound interest. Cool. I'm like 8 years old. Like, what is this going to do to me? And I do remember at the time, like I remember, early 80s for me when I was a child, I would get my bank book, and back then the interest rates were high, like 13% for the economy. So I was getting relatively decent stuff, not even anywhere near as high as the high yield savings accounts. But I remember I was like, oh, my money is making me money. That's really cool. Of course, I wish that stuck with me. I'd be a multimillionaire right now if I worked on compound interest for the last 40 years. But hey, better late than never. That's why I constantly recommend anybody at any age start. Obviously, if you're older, time is not on your side as much as it is if you were in your, teens or 20s. But I'm 44. I started just a couple of years ago. It's already made a huge difference for me. So highly recommend anything that could do with compound interest. And again, I learned that when I was like 8, but I wish, they taught more of that, or really kind of showed you, hey, maybe middle school, maybe high school, even high school is like, hey, instead of taking, pre-calculus, which, very few people are going to use unless you're going to a field that requires that, let's teach you finances. Let's teach you about compound interest. Cool. Now I'm 16, 17 years old, about to get my first job. Now I can learn about investing. I can learn about compound interest and how all of that works. I can learn how to actually build wealth before I get myself into massive debt. So we can dive into conspiracy theories about that all day long about why they don't teach us. But I know at least my son in high school, they started to teach that, and that's starting to come around now. Grateful about that. But hey, I'm trying to help you guys out. Some education that those of us who have been out of school aren't learning. So any chance I can help you guys, I'll do that. Yeah, they just dropped the savings to 4.5, but it was 4.6, so 0.1%, not huge. And again, this is expected, fully expected that we're going to be seeing interest rates coming down for high yield savings accounts. This is across the board. Some pay higher, some pay are like, I think I'm seeing 5.2% and higher in some other places, but this is to be expected. Again, the Fed going to be cutting rates in September, coming down to, even if it comes down just 25 basis points, I would fully expect that high yield savings is going to come down a significant chunk. This is why with my spreadsheet, it's showing me, hey, as the market's coming down, I can spend more money. And then if I see it, maybe the market ends up going up, which with the election coming up, I highly doubt it's going to come up a lot in the next 2 months. I have a feeling that by the end of October, we'll probably be lower than where we are right now, even if we get some fluctuations up before then. But, just paying attention to that. And if all of a sudden I see, hey, my high yield savings account is bringing in 3.5%, I'll switch my strategy a little bit because it's never good to just stick with your strategy regardless. Always be, agile and adjust your strategy. So if I see it drop down to like 3.5%, I'll say, hey, maybe I want to take a little bit more of that cash out. But on the flip side, if we are going to get into a recession, even 0% coming in for a yield on your savings could be better, to keep your cash on the sidelines waiting for better deals. Because if we get into a recession, we could see a 40 or 50% drop in the entire market. So even if you don't get anything from a yield on your savings, buying in at those lower prices will return that yield tenfold. So just remember that that's that. And again, nobody knows if we're going to get into a recession. You have no idea what's going to happen there. We very well may not hit one and we keep on going up. But to me, this is why I'm adding that money in as we get the dips to have that. So if we don't get one and we run from here, I'm still invested. But it's always good to be prepared and have that cash on the sidelines as well for any opportunities that present themselves. Plus, for me, I kind of want to get my portfolio up to 10% anyway, just on a regular basis, just to kind of sit it there again to be able to take advantage of any opportunities that are out there. Now, if we're in a place where rock bottom prices and we're showing signs, let's say, for instance, again, don't know if this is going to happen, but let's say, for instance, we hit massive recession, stock market comes down 50%. Awesome buying opportunity, horrible for the economy, horrible for anybody that it affects when it comes to losing their job. But anybody who's an investor and can take advantage of these opportunities, that's awesome. Now, you take a look at the signs. We've been seeing the signs slowly recently about employment going up, about a potential recession. We will end up seeing indicators of us coming out of recession that are very similar. So you'll never be able to time the bottom. It's impossible, just like you can never time the top. You can get lucky, sure. I try to get somewhere within the 5 to 10% range of those areas, and dollar cost averaging historically has always been the best way to do that. So my spreadsheet kind of helps me out with those areas to be able to catch more of that top or bottom when it comes to it. And I'm not much of a seller of my stocks, but when it comes to buying, just because I add a lot more, I can really see when we're coming lower. So when we start to see those indicators of, hey, the economy has bottomed out, we are starting to heal from what we have ever gone through, that's where I can say, all right, you know what? Maybe I don't want 10%. Maybe I'll drop it to 8% and I'll start deploying cash and I'll do kind of reverse. So, if I can bring it up here, I'll show you guys my strategy because I just broke out my level 2 strategy for my investing. Here we go. Let's see. Break this out for you. No, not there. All right. So here's my strategy right now. So again, these are all the phases and these are just the levels, and the levels are arbitrary, sort of. So with the higher yield stuff, the stable stuff, I wanted a higher dollar amount in them just because they're going to be bringing in a higher yield for me initially. And the goal is to get to that up there first because all of that money doesn't drip in. I take all of that cash and deploy it elsewhere. That's where I get most of my money because I'm only putting $50 per week into my investing just because I have all the other bills that I'm paying with the buying the house and other stuff. So I can only afford $50 a week. So I'm relying on another $200+ every single month coming in to be able to go. Actually, it's about $350 coming in just in cash to be able to put into all of this stuff. So I don't drip it, but again, I'm just having it in the higher yield areas allows me to bring in more money faster to be able to build this up and grow it faster. So coming down here, I just finished up phase 8. So I'm doing the cash first. So phase 9, I've got myself to 9% cash, and I'm actually still finishing off some of these numbers because as the market has sold off, I haven't hit those phase 8 levels. So I was at phase 8, but now as the market sold off, I'm dipping below. Once we get to a point where all of the phase 8 is securely there and paid off, and I'm still at 9% cash, then I start working on the phase 9 stuff, and I'll start filling that out. And then after I finish phase 9, then I move into phase 10, which is 10% cash. Now, level 2, I'm slowly building up cash slower. So knowing how quickly I'm going to be building this up, I may not finish phase 10 till middle of next year. And at that point, we might be in the recession and maybe I want to be deploying more cash and not saving more. So this might be adjusting over time, but I figure at this point, I'll be adding less and less cash to my portfolio and maybe even spending it. But that's how my whole entire level 2 went through phase 10 was building up to 15% cash, which I really don't want more than 15% because if I've got 15% cash, that means that there's really no good deals out there. And to me, because I have a small portfolio, there's going to be plenty of deals for me. So that's kind of where I'm sitting right there on all of those. And yeah, so let me see what else we've got. What else? So who out there bought anything today? Were you guys buyers? Because I definitely added. I'll show you guys what I ended up adding today. Where is it at? There we go. Yeah, so I added a lot today. I added to JEPI, I added to HTGC, I added to Hess Midstream, I added to Maine, added to Devo, just not enough. I added to VYM because I ended up adding to VYM and then the market pulled back even further. So, that's where Devo ended up popping back up. Added a little bit to CGDV today. Earlier this week, I added to a bunch in here. I actually had Occidental up. And so here's another thing to pay attention to also is one of the catalysts and triggers that we have seen in the past to get us to a recession is a jump in oil prices. Oil prices just dipped below $70 per barrel. That's extremely low. Obviously, we know we have some turmoil going on in the Middle East. We don't hear about it a lot recently because of the elections that are going on, but there's stuff going on that's over there. So, at what point are we going to get where they're all of a sudden OPEC or whoever is like, hey, you know what? We want to go up on oil prices because they could just arbitrarily go up on oil prices to be like, you know what? We're going to restrict the supply and that's it. And now prices go up. So we can get a shock to the system with oil prices going up. Do you think all those oil manufacturers and producers out there right now are saying, going, hey, we're totally happy with us not making as much money because barrel prices are only $67 a barrel? No, they're not happy with that. So eventually we're going to see a flip in that most likely, and that's going to turn around. I'm all for electrification. I'm all for EVs, but we're not there yet. There's still a huge demand for oil, and that is going to come back at some point, especially when we hit the winter months and we get a cold winter, and all of a sudden people need to spend a lot of money on oil. It's going to happen. Then all of a sudden we see that oil pressure go up. The oil price goes up per barrel, 70, 75, 80, $85. Now all of a sudden you see those oil stock prices going back up. That's why, I've been seeing ExxonMobil and Occidental as I own them. Those have been dipping down, but now I can add to those. I'm adding to them now while they're down. Then the oil prices go up. That's when we get that shock. So pay attention to oil prices because oil prices going up could be that shock. Right now we have credit card debt at an all-time high. We have consumers out there where, yes, the retail numbers came out last month looking good, but they've been really bleak for the first half of this year. So it's the first time we've been seeing them good to kind of show signs of a stronger consumer, but are they really? We've been seeing still tons of layoffs going on out there, still hearing about more and more layoffs. Obviously, we see that going on with the jobs. So it's just one domino after another is falling. And all of a sudden, we get to a point where, hey, there's less consumers, less money being spent. Then all of a sudden, oil prices going up. If people are out there already full with their with debt, now all of a sudden they can't afford gas prices. Oh man! Now, of course, when you get to unemployment, hey, maybe with unemployment, less people are driving. We kind of saw that during COVID, but that was a massive pullback in employment because everybody had to stay at home. But if that balance is great, but again, that initial spike could push us over the edge in oil. Another thing that people have been talking about is AI. Sure, we know that part of the AI bubble, I don't want to say a full bubble popping right now, but that AI excitement that we had in the beginning half of the year is starting to dwindle because the return on that investment isn't showing up yet. Very similar to the dot-com bubble. Difference between now and then is the dot-com bubble had a lot of shell companies that just, as long as you had .com on your name, you were making huge money, even though you had no actual company behind it. The companies right now are real, but there's no return on that investment yet. So these companies are investing a ton of money into AI with no return on that investment. There are some areas that they are getting some investment return, though. Sure, maybe they're not creating any new programs that are, able to be sold to consumers, but they're replacing some jobs with AI. So you've got a lot of the stuff that we see online, people maybe doing website design or different designs for different things online. AI is doing some of that work now. So some of these people are getting their jobs replaced by doing online jobs that AI is able to do, coming up with different, products and things like that online that they can do. They can replace some jobs. Yeah, we don't have humanoid robots that are coming out. We don't have robo taxis that are coming out to replace any of those jobs, but there are jobs that are happening on the internet that are getting replaced by AI. So that is starting to happen already, and that can just kind of perpetuate going down the road. And if we end up seeing that perpetuating down the road, are we going to see that just continue and grow and grow and grow? And unemployment never actually recovers because we have AI taking over a lot of those jobs. Again, just one of the scenarios that could be potentially playing out that we just have to pay attention to. Oh, let's see. My dad chiming in here. Um, let me see. Dell and Palantir added to S&P tonight. Uh, yeah, yeah. So Palantir again. That's one of my big ones. And Dell. I know Dell just had some pain recently. Sounds like they're not sure what's going on as a company. They're kind of getting almost like an Intel, where Intel is kind of folding it up. They're not, they might go bankrupt. I don't know. Intel obviously 20 years ago was a huge player in the internet space when it comes to computing and chips and everything. But now with Nvidia, AMD, other competitors out there, Broadcom, Intel kind of fell behind and they're no longer in favor. And Dell might be going that same way, but they're working on things. But we'll see how Dell does. But from a swing trader standpoint, and now for you guys who don't know, my dad is more of a swing trader. He taught me a lot of what I know for swing trading. He's very successful with it. For me, because I'm working full time and just getting my emotions involved in it, I feel more comfortable with just longer term investing in dividends, two completely different strategies, and we're both being very successful. So, from a swing trader standpoint, Dell, phenomenal. Palantir could be one as well. I think Palantir is also a great long term play, but very much like an Nvidia, like a Tesla. It's great long term, but in the near term, very good opportunities from some swing trading on all of that. So if you guys are interested in that, I did tell you at some point in the future, I will make a video sharing my dad's strategy. Again, none of it's financial advice, but it's a very basic way of how he does it when it comes to swing trading to be able to get yourself, just a basic learning experience from that for where he does and how he's successful with that. All right. I'm going to hop off here in a few minutes, but you guys have been awesome tonight. Thank you so much for being on here. This is my first live stream. Oh man, I don't even know if I did one earlier this year. It's been a long time either way. So I appreciate all of the support of you guys being on here. Over 90 of you on watching right now. I love it. I appreciate all of you here. This feels good. I love getting back. So I'll probably end up doing this on a regular basis. I might end up doing it, seeing as you guys are on here loving it on a Friday night. Maybe we'll keep it on Friday night at 6:30. Sounds like a great plan to me. So we'll do these live streams to kind of do a weekly wrap up. And again, so looking at this week along, doing a full weekly wrap up. Monday, we saw a big sell-off in the market. And again, I think the market is starting to look at, they really haven't priced in a recession. Most of the market is still pricing in a soft landing, but starting to kind of reflect and looking at these jobs numbers. We get the JOLTS numbers that came out on Wednesday. Those weren't very good. They were lower than expected. We were expecting 8.1 million and we got 7.67 million. So looking at the data coming in, just looking a little bit, weaker. Again, we're moving in that direction. So I think a lot of investors, plus we have lower volume, so that typically moves the market a lot more. But when you have investors, institutions, hedge funds, just uncertain about where we're heading in the future, especially with elections coming on, there's just like a bit of a pause. People kind of taking some money out and just being like, let me just sit on the sidelines and wait it out. Patience pays off. As Warren Buffett says, man, totally drawing a blank on this, but it's just passing, the stock market is really just passing money from the impatient to the patient. And that's really what it is. And I learned that early on. I was very impatient, concerned about the daily stock movements. Every time the stock moved one way, is it going to go higher? Is it going to go lower? What do I do? Do I buy? Do I sell? That's being impatient. That's being an emotional trader. That is never going to earn you money. It has lost me money every single time I have done it. That's why I don't do it. Because when you're emotionally investing and you're emotionally trading, you shouldn't be emotionally investing. Let me straighten that out. If you're investing, there should be no emotions whatsoever. You should strictly be looking at somebody's balance sheet, look at the company, look at the ETF and how they operate as an ETF. Hey, is this something I want to be in long term? And investing should be like a Warren Buffett style approach of, I plan on holding this forever. Or if I'm not, for instance, I have some of my high yield income plays up top. These I don't plan on holding forever. These are strictly here to bring me in. They're bringing me $181 every single month. This is just feeding the machine faster. Literally all they're there for. I sold one of them off. I sold KLIP because I was still up on it overall 20%, but that number was dipping down. So I didn't like that. So I took that cash out, deployed it elsewhere. So these here are still bringing me in a lot. Like total return on all of these, all-time total return. YMAX I haven't had for all that long. So, that one hasn't returned a bigger yield. But I mean, Coney, I'm still up 181%. QQQY, 44%. JEPY, 32%. So still way, way up on these. So actually, Coney, for instance, I sold so much because they got up to almost $28. I sold a lot of that early on, made massive profits. I'm basically playing with the casino's money right now. I'm playing with the market's money on this. So I can let this go all the way to zero and I'm still profitable on it regardless. So for me, I'm just letting that go. And then again, my stable plays are bringing me $158 per month. So these here, I don't plan on keeping forever. These other plays here, the stable plays, I plan on keeping them forever, but I don't plan on them being the main source of my income. And if I see anything go south with them, they'll be the first ones to go. All the rest of my plays, again, I track them regularly. I want to make sure they're not going anywhere. But all the companies, I just make sure, hey, are their earnings still going in the right direction? If they are, I plan on holding these forever. Now, some of these I may consolidate, especially as we go into a potential recession. I may consolidate some of them. I've got a lot of plays here, maybe more than I need to have. And I have a lot of overlap, especially with the ETFs. But I may consolidate down, pick some of the top winners. I basically have 4 stocks in every single sector. So I'm very well diversified. My portfolio moves basically right with the S&P 500, and that's it. My dad, I miss the orange, yellow, and green couch. Yeah, yep. This is my new studio for you guys who are just hopping back on here. My new studio. This is actually going to be where I put the kitchen. So I'm still going to be able to use this as my studio. I'm just going to kind of be pushed back a little bit because where I'm sitting right now will be almost on cabinets. But oh yes, honey, thank you. Don't forget to like, share, and subscribe. Yeah, that's one of the things I appreciate too from you guys is in my shift, and you guys, and honey, if you're one of them who's been around with me almost since the beginning, I started this channel as all around investing for everything, kind of shifted into Tesla. I loved the company, appreciated Elon, all the things that have been going on there. And then as I progressed as an investor, I saw a lot more opportunities that were out there, especially as Tesla was coming down and trading sideways. I didn't lose faith in the company long term, but I also recognized how stocks can move and be manipulated in the near term and how I can have my money in other places to take advantage of those opportunities. Because at the end of the day, I'm in this for me to be able to build up my own net worth and build my portfolio up. And seeing a stock that is trading sideways and going nowhere for a couple of years, knowing that I have an opportunity to actually build my wealth in other places to be able to buy more of that one that I like long term, that made a lot more sense to me. So as I have shifted that with the channel, of course, the YouTube algorithms aren't a huge fan of that. So my videos aren't getting out to a lot of you. I know many of you have already told me that you haven't seen my new videos popping up. I've been making them consistently for the last few weeks now, but some people haven't been seeing them. So again, any liking, sharing, or anything to get it out there as I'm changing the direction of the channel, it'll be a huge help. So I appreciate all of that from you guys. Thanks, Dad. My dad, awesome. I was actually thinking about my dad, both of my parents, but especially my dad. One of those things where the support that he has given me in my life is very much a parent. If you're a parent out there, I highly recommend this kind of support. Everybody, not telling anybody how to parent, but this is, how I've, raised my child as well. Is I always want to be excited. My dad has always been, supportive of anything I've wanted to do, but he's always been that voice of questioning. And I've always taught my son question everything. I always question everything. And it's nice to have somebody like my dad, and my mom does it as well, to question what I'm doing. Hey, I see that you want to do this. I see you're excited about this, but let me throw some questions at you that maybe you didn't think of. Things that, hey, I'm so excited. Maybe I feel like I'm invincible, but you're not. So just think about these things and be cautious. And it's that cautious but supportive and optimistic parent. So, Dad, thank you so much for that, because that's been a huge proponent in my life as to why I'm at where I'm at right now. Oh, yes, Hanif. My t-shirts and hoodies on my website. So I do have a link down below. And now I apologize because I haven't been on there in a long time because I've been so busy with the house. But I do have a merch store. There's some awesome stuff that's in there. And I'll start putting the shirts on here as well. There's Be a Good Human t-shirt that's on there. A lot of different ones, and they're all made. I designed, so I came up with the slogan for all of them, and I had somebody design the shirts for me, so I put them on there. So please check out that in there. And Hanif has been a huge help with a bunch of that, with some of the ideas as well. So check that merch store as well. So that's all I've got for you guys. Again, thank you so much for being on here. Loving the support. So I will definitely be on every Friday at 6:30 p.m. unless I have something else going on that comes up, like 2 weeks from now, I'm flying out to Kansas City to visit my son at college. So obviously will not be on at that point. So I may do one earlier in the week. we'll see. I'll keep you guys posted. But otherwise, that'll be my time going forward. So again, thank you guys so much for being on here tonight. Hope you guys are doing well in the market. Hope you guys keep on following along on here. I'm going to try to give you guys as much of my wisdom as I possibly can and share from there. So thank you guys so much. I appreciate all of your support. Have a great one.